In 2012's first half, we saw some stellar apartment occupancy rates, but a bit of a slowdown in rent growth levels compared to 2011. Did that pattern hold up through 2012's third quarter? We're going to take a look in today's episode of Apartment Market Dynamics from MPF Research. I'm Jay Parsons. He's Greg Willett, and today we'll be highlighting results from our third quarter national survey. And Greg, the big number on everybody's mind is that rent growth stat. So let's not keep them in suspense. What happened?
Let's jump right in there. We'll begin with the chart here right away. This one showing annual change in effective rents for the country's top 100 metros. What you see here is that pricing is up 3.3% on an annual basis. That means the slowdown in rent growth seen in the first half of the year actually is continuing. That annual growth number peaked out for the cycle at 4.8% at the end of last year and now has worked its way downward for 3 consecutive quarters. Important to realize is that 3.3% though is still a pretty decent number. The average for the past 20 years or so is around 2.5%, looking at the highs and lows. Furthermore, if you dig into the last couple of periods of sustained expansion, most recently, that would have been early 2005 to the middle of 2008, and before that, throughout the middle to late 1990s, the average rent growth number came in really pretty much exactly where it is right now. For a little bit more insight into how we've gotten to today's annual stat, let's switch from the annual view to the quarterly view. Rents for new leases climbed an even 1% during 3Q, which again is a pretty healthy number. But let's back up to the second and third quarters of 2011. What you see there was that quarterly growth then was running at 1.6 to 1.8%.
And Greg, let me add a little more detail to that by talking about what's happening in a few specific markets. And really what's impacting that national number is at the really top end of the national leaderboard, we're seeing a bit of a slowdown. Among large markets with at least 100,000 units or so, the Bay Area metros continue to post the strongest annual shifts. Rents are up 8% in San Jose and 7.5% in San Francisco. Some terrific performances. However, those stats compared to the recent peaks in annual rent growth, compared to 13.2% in San Jose a year ago and 14.6% in San Francisco at the end of 2011. Now, there are just under 400,000 apartment units between San Jose and San Francisco, so a slowdown of that magnitude in two markets of that size is going to impact the national results. So let's show you the rest of the nation's top 10 for annual rent growth among large markets as of third quarter. In third place, another Bay Area market, Oakland, 6.7% growth. Charlotte and New York round out the top 5 with hikes of 6.3% apiece. And then the three markets right around 6%, Columbus, which has really been the star of the Midwest of late, and then Hartford and Denver. And the only other large markets above 5% rent growth in the past year were Houston and Nashville.
All right, Jay, let's look at some other key stats and particularly focus in on that supply-demand relationship and the resulting occupancy numbers. And we've got another chart for you here. Looking across the top 100 markets, demand came in a hair just under 62,000 units in third quarter. That compared to completions slightly over 26,000. For the 12 months ending in September, demand tallied at 146,000 units versus completions right at 80,000 units. Now those are pretty solid demand numbers, but actually to some degree they look like they're being constrained a little bit just by the fact that so much of the product is full at this point. So let's look at some occupancy stats for third quarter. The occupancy number nationally is 95.4%. We're up 20 basis points for the quarter, and we're up 50 basis points on an annual basis.
And one final number to share for you, construction. At the end of the third quarter, among the nation's top 100 metros, construction totaled 191,000 apartment units. Now that's about double the low point in ongoing construction seen at the end of 2010, but it's still less than 2/3 of the peak that we saw in the previous cycle back in 2008. Now there's lots of debate going on right now about what the appropriate construction number is. Our take is, so far, so good. although it's probably best not to drive that number all the way back to pre-recession norms north of 250,000 units. There are places like Atlanta and Phoenix and Vegas where we just don't need to see deliveries nearly as high as what we saw prior to the recession and during the recession. So our view is that something in the range of 200,000 or maybe a little bit north of that is a good number. If we get much above that, that's when we're going to start to see occupancy rates begin to ease back. But I should add this, what you saw in that chart there is that construction is trending upward quickly, but I think that number is going to be leveling off over the next year or so as that first wave of new development starts to come online, and I certainly don't think we're going to be back to that 300,000 number anytime soon. So Greg, I'll throw it back to you for some thoughts on what's going to happen going forward. Obviously, the big question is rent growth. That's what we started with. Let's come back to it. What's our forecast going forward?
Our take on the rent situation is that we're going to plateau there pretty much at the level we're seeing right now in terms of annual change. And a couple factors come into play there. Again, we think that the occupancy number does remain really strong, that even though we're adding some significant new supply moving ahead, the demand's going to be there to absorb that. And then also coming into play, just some simple math, as we've seen this slowdown in the annual change over the past couple of quarters, it really reflects that we've dropped off some big quarterly numbers from a year ago. But what we have dropping off in the future, they're not off the chart numbers in terms of the quarterly gains. So that's going to help us. But of course, there is that wild card of operator behavior that will be what really could have a significant impact there. And we are entering this phase of the cycle where people are just going to move a lot more than they have in the past. And some people will be going to the new product coming on stream. Some are going to head down into maybe some more affordable product because of the rent growth that's been seen of late. The for sale sector is coming back to life as well. Mm-hmm. You're going to lose some more people to purchase. So how will operators react to that more aggressive churn in the renter base? Occupancy can remain high, but you're going to have to lease a lot of units to actually keep it at that spot.
So that wraps us up for today's episode of Apartment Market Dynamics. Join us next week as we start looking at some individual markets, and we continue to do that throughout the rest of the quarter. So until then, for Greg Willett and for MPF Research, I'm Jay Parsons. Thank you for watching Apartment Market Dynamics.
Want more? Go deeper with MPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, MPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.